What I want to do is give you some intuition about whether you ought to be thinking about commodity funds as a good investment for your clients, as sort of a neutral investment for your clients, a bad investment. Are there clients for whom commodity funds make sense? And this actually is a topic that's near and dear to my heart. My PhD dissertation was on commodity futures. And I taught the futures course probably for the first 10 years that I was an academic. I taught futures and options. So at one point in my life, I actually knew a lot about this stuff. And it's interesting to go back and reflect on it. Given the current interest among lots of the advisors we talk to try to understand whether, in fact, this is an interesting thing for your clients to be invested in, or if it is, which of your clients ought to be in here and why. Okay? Now, to start with, here's what the first slide says. If you look at the data, if you look at the papers that try to summarize the data, commodity futures funds look too good to be true. Basically, you get the same average return as stocks. You have a Sharpe ratio that looks like stocks. They're negatively correlated with stocks and bonds. They're positively correlated with inflation. So basically, you get the same risk-return relation as you have in the market, but you get to diversify your portfolio, add them negatively to stocks, add them negatively to bonds, and it's an inflation hedge. What more could you ask for? Okay? It sounds wonderful. It's a panacea. I give you this, and you've got to add it to your portfolio. It's just wonderful. The problem is, futures are a zero-sum game. In other words, you can think of them as bets. All we're doing with a futures contract is I'm going to bet that the price of wheat is going to be over $4 a bushel, and you're going to bet that the price of wheat is below $4 a bushel. If it turns out to be $4.30, I bet it was over $4, so I make 30 cents a bushel. Where does the 30 cents come from? Your pocket. All we're doing here, whatever hokum you read in the financial press or in the prospectus from Goldman Sachs, all it is, we're just betting about what the price of a commodity is going to be when the contract matures. So in my example, I made 30 cents and you lost 30 cents. That's always going to be the case here if we ignore transactions costs. Somebody's going to win some money and somebody's going to lose exactly the same amount. So if we look at, these data happen to be by two friends of mine, Gary Gorton and Garrett Rowenhurst. This, if you actually want to read a paper, is the best paper on the subject. And it truly is the best. And to be honest, they don't actually say the misleading things that some people interpret it as saying. Okay? It is a very good paper that is very well framed and set up. But people misinterpret their conclusions. So they find these great returns. They find negative correlations, positive correlation with inflation. What I want to do is walk through and try to understand, is this a good thing or a bad thing? Should you put your clients in here? Should you pay fees to put your clients in here? Are there types of people? I mean, think about it now. If you start with a general equilibrium perspective of the markets, which is the way you got to frame things, right? Basically, the world's in equilibrium. There may be some little tweaks and quirks and stuff, but the world is very competitive. Financial markets are really, free entry, very minimal transactions costs. The world is really competitive, nice and equilibrium. We've got an asset out here in zero net supply. Futures contracts. For every short, there's a long. Every long, there's a short. A normal asset that we're talking about is in positive net supply. Stocks, bonds. Somebody's got to hold them. Your clients want to invest. The default ought to be, let's put them in the market. And then you got to convince yourself to move away from the market, right? That ought to be the process you always go with. You get a new client walking in the door, and you say, okay, the default condition here, let's put them in the market. And then, okay, maybe that's not the right portfolio for them. Why not? So the default ought to be the market. Well, there are no futures contracts in the market. It's in zero net supply. So if I add up all the wealth in the world, just like it doesn't include bets on the Super Bowl, the market does not include bets on the price of wheat. So the default here ought to be, there's no reason to put your clients in futures. And then if you say, okay, we're in this equilibrium market, the default is there's no reason to put your clients in futures. You got to step back and ask yourself, okay, for this client, is there something special about them that should make this client want to be long futures or short futures? Remember, for every long, there's got to be a short. Just like for everybody tilting toward value, there must be somebody tilting toward growth. For everybody who ought to be going long for some reason, there ought to be somebody who wants to go short. There's got to be. The discussion here was about, well, aren't there natural shorts? Aren't there producers who need to be, they're actually going to be delivering wheat in the future, and they want to hedge that risk by selling the wheat today? Okay? In 1950, that was a sensible story. I'm not sure that's a great story to explain a broad basket of commodity futures, which includes things like silver, oil, heating fuel, oil, gas. Those are the market baskets we're talking about today. It's no longer the wheat futures that dominate these instruments. And even if it is, let me get there. It's possible there are natural shorts that are willing to pay, but we'll get there. Okay? So when I think about this, I say, look, in aggregate, there aren't futures contracts in the market. So I got to decide what's special about my clients that make me want to pay transactions costs to put them in this instrument. Okay? That's the way I frame this. I want to go through step by step and think about the different components of the empirical evidence here. Remember what they find. They and a bunch of other people find big positive returns to holding commodity futures. What is the source of that return? Well, to start with, we've already talked about what the payoff is on a commodity futures contract. S, in my language, that's the spot price. Capital T is going to be when the futures contract matures. And F is the futures price. So in the example I gave you before, wheat futures contract priced at $4. That's the F there equal to 4. The spot price turned out to be $4.30. That's the S equals $4.30. So you get $4.30 minus 4. I win 30 cents. And you'll notice a common theme here. I always win. So I always set it up. Isn't that the time value of money? Thanks for the question. There is no time value of money here. Why? Because you don't have to put any money up. To be more precise, both parties to the contract put money up. And it's just good faith money. It's to ensure, the way I always like to think of it, you go to a biker bar and you're going to bet on who's going to win the Red Sox game this week. Now you know, if you lose the bet, you're paying off. You'd like some assurance that if the other party loses the bet, they pay off. So what do? Well, you both put your money up with the bartender. That's all a margin account is. Both the long and the short put their money up with the bartender. But basically, it's just good faith money. And it's a bit more complicated than I describe here because there's something called daily settling up. Daily settling up just means you take your profits and losses every day. The benefit of that is you don't have to put up so much money every day. You don't have to put up 3 months of risk. You only have to put up 1 day of risk. Okay? But you can ignore all of that. That's irrelevant for this discussion. There is no opportunity cost of funds here. You can put up Treasury bills as your collateral, both the long and the short. Okay? So the payoff is just going to be whatever the spot price turns out to be minus the futures price. And the expected payoff is the expected spot price minus the futures price. We know the futures price. We agreed on it today. We just don't know what the spot price is going to be. The return on the futures contract, notice there's no money put up. So it's hard to define a return in the normal sense. You don't divide the payoff by the amount of your investment. So there's sort of a standard that people use, which is they divide the payoff by the original futures price. That's just going to be the definitional return on the futures contract. It's the payoff divided by the original futures price. And then you may choose to think about this as a collateralized investment. And this is the way these funds are typically created. So I'm going to invest $4. and then take a $4 bet on wheat futures. So I take a $4 position in the wheat and simultaneously put $4 in Treasury bills. Okay? Now, it may get a bit more complicated or sophisticated than that. We may use something other than Treasury bills for our investment. But for the time being, just think of it as if you took $4, put it in Treasury bills, and made a bet about what the price of wheat's going to be. Okay? That's essentially what's going on here. So the total return from your collateralized investment, I'm going to call that R sub C fut. That's the collateralized futures. That's equal to the T-bill rate of return. Now I do have an opportunity cost of funds. Plus this defined return on the futures contract. Make sense? Okay. We'd like to estimate what the expected return is from this futures. The problem you have right off the bat is futures are incredibly volatile. They're about as volatile as stocks. They're just about as volatile as a big basket of futures, well-diversified basket of futures, is about as volatile as the overall stock market. Now, in the stock market, how long does it take for us to figure out that the expected return on stocks is greater than the risk-free rate? You'd like some statistical precision to infer that the expected return on stocks is greater than the risk-free rate. You guys have heard me give this lecture. How many years does it take to get a t-statistic of 2 here? 60. It takes about 60 years. Okay, so now we've got an instrument that at best, Gorton and Rowenhurst go back to 1959. So they've got about 40 years, 45 years. Right off the bat, you got a problem. If you thought that the premium on futures was as large as the premium on stocks, you're going to need 60 years. Okay? That's the problem we got right off the bat. So let's look at the data. All right, so before we look at the data, let's think about theory. What's modern portfolio theory say? I can dive into this much more deeply, but let me stay on the surface for a moment. Modern portfolio theory says, look, if there's a premium on this futures, it's going to be a compensation for some sort of common or systematic risk. What might that be? If you think about it, now we're making a bet about the price of a broad market basket of stocks, of commodities. So a big, broad basket of commodities. What's the risk associated with that? What's the common underlying factor associated with that big, broad basket of commodities? It's inflation. That's pretty much how we define inflation. It's movements in the price of a big, broad basket of commodities. So yeah, we're taking a subset, but a fairly large subset of the assets that we define inflation from. So what's the risk? The risk has to be inflation risk. Do I have to pay you, or will you pay me to insure you against inflation? Just before we start looking at the data, which way is the price going to go here? I'm going to insure you against inflation risk. Do I pay you for the right to insure you, or do you pay me for the insurance? Before you start, you're guessing you're going to be paying me. So if this is, in fact, the systematic risk that's getting priced out in this market, your priors are the expected return on the futures contracts is negative. Why? Because the long is buying insurance against inflation. That's what modern portfolio theory would predict, that we get a negative expected return here. Okay, but we don't have to stay with modern portfolio theory. We can go back to this classic hedging story that we were discussing earlier. So we've got wheat farmers in Iowa who want to unload their price risk. They know they're going to get their wheat crop. The wheat crop doesn't come in until the fall. They actually have 2 or 3 wheat crops in a year, but let's talk about just the fall one. So what do? They sell it forward. What's the real risk? Particularly if we're talking about a commodity that's typically grown in a common area. Your real risk is quantity, not price. Right? Your real risk is quantity, shared quantity risk. So in good years, which is a good year? A year where everybody's crop doesn't do well, or a year in which everybody's crop does really well? Well, that's the best, is where everybody else does poorly and you do well. But it's actually, it cuts both ways, and you can see it immediately. If we're all doing poorly, prices go up. My total revenue might actually go up. And that's the last time you actually, that's the last situation in which you actually want to be selling your wheat or beans forward. Right? Because you've got to go buy the wheat to deliver into your futures contract. So you've got a problem. Okay, not only that, but we now live in a big modern age with lots, basically financial markets are hardly segmented anymore. Okay, we've got these integrated financial markets, this classic hedging story. It's as if there's a bunch of wheat farmers that come to the futures exchange and there's 20 people standing around offering to sell them insurance. That does not sound like the financial markets I know and love. Okay, what we have in financial markets these days is broad diversification. With that sort of broad diversification, sharing the risks, you don't expect a lot of risk premium from this little isolated type of risk. We don't talk about, gee, there's got to be a big premium for Eastman Kodak. Why? Well, the premium we need for Eastman Kodak is photography takes off. Okay, if photography takes off, Kodak's going to get a really high rate of return. And if photography doesn't take off, Kodak's going to get a really low rate of return. And as a result, I need a lot of insurance against that photography risk associated with Kodak. That's the wheat story. It's possible wheat really takes off, and as a result, the farmer does well. Or wheat really shrinks, and as a result, the farmer does poorly. And there's a big premium associated with that insurance. We've lost all of modern portfolio theory when we go there. But let's stick with it. Let's suppose we stay there. Give away all of modern portfolio theory. What does that imply as you and your clients move into this market? We got all the wheat farmers trying to buy insurance. Let's imagine they do, which they don't, but let's imagine they do. And you've looked at the data and inferred there's a premium. All the financial advisors decide, you know, this is a great investment. In this segmented market that we're talking about here, what happens to the premium? It's got to go down. Remember, the reason there was a premium is because this is a very isolated market. You and all your friends flood into this isolated market, you're changing prices. When you give up modern portfolio theory, you look at this little segmented market now, you're going to move prices. And you're going to move them against yourself. Okay? So theory says, okay, if it's modern portfolio theory, probably the source of risk here is inflation. And if it is, our guess is the longs have to pay to buy inflation insurance. Okay? Later on, I'll come back and show you things like implied correlations with inflation. But our best shot is that modern portfolios theory suggests a negative premium here. If you go, no, I don't believe in modern portfolio theory. I like the classic hedging story. Okay, that's fine. But in that world, we're talking about a little corner, a little pocket of traders. And you're flooding in there with your dollars, and you're surely going to affect prices. Okay, against yourself. So either way, I'm not sure you want to infer. We got lots of premium here. Now, what about the empirical evidence? These numbers are all from Gorton and Rowe and Hurst. And the data I sort of mislabeled. It's July of 1959 to March of 2004. So I compromised a bit here. 59 to 2003. And what they calculate is, what they do basically, is they take some data from the government and they build an equally weighted index of all of the surviving futures contracts all the way back to 1959. Now, as soon as I say the surviving futures contracts, some of you, your heart probably starts fluttering and you're worried about survival bias. If I showed you the return on just the companies that survived from 1959, you got a serious problem there. It's not necessarily a problem when we're looking at futures. Futures don't die because the price went down. Futures die because the volatility goes down. Okay, why are there futures contracts? There are futures contracts because there's lots of volatility. You got people who might like to trade back and forth to offset their volatility. So it's typically, when you see the volatility on an instrument go down, chances are that contract's going to die. It's not dying because the price went down. So the survival bias in their index is probably not a big concern in drawing inferences on their data. The average return they got from their collateralized position, and again, what they did, they're equally weighting whatever contracts are out there, whatever commodities are out there. So in 59, it's dominated by agricultural commodities. In 2000, it's dominated by oil and things like that. Okay? So it's just basically look at the Wall Street Journal, equally weight whatever commodities are there. That's what they have in their index. The average return on their index is 11%. That's an average annual return of 11%. If I just look at the spot commodities, rather than take the futures, what was the change in the price of a basket of commodities underlying the futures? It was 8.7% a year over this same time period. So this is actually going to be critical to our analysis. I want you to understand. The first one is just we're rolling over these futures positions. We get an average return of 11%, including the T-bill rate. The alternative is, imagine you didn't have to pay insurance, storage costs, anything like that. You just bought the spot at the same time that you initiated the futures contract, and then sold the spot when the contract matured. Okay? What would the rate of change be? What would the rate of return be if you didn't have to buy insurance, pay for storage, any of that other stuff? In other words, what's the rate of change in the spot price? 8.7%. And then the T-bill return was 5.5% over this time period. So right away, you know the futures contracts had a return of 5.5%. I'm comparing the 11 to the 5.5. Okay, 11 on the futures plus T-bill minus the T-bill gives me the 5.5. And then the interesting number here is inflation over this same time period was 4.2%. That's a shocking result. There's two numbers here that, like remember when you used to look at those drawings when you were in grammar school? What's wrong with this picture? There's something wrong with these numbers. The problem is I have a broad market basket of commodities here. They went up at a rate of 8.7%. And inflation only did 4.2%. Pham and I look at this and say, you know what? There's unexpected relative price moves here. Here's what I'm asking you. If I told you next year inflation turned out to be 3%, what's your best guess of the change of a broad basket of commodities over the next year? Inflation's 3%. 3%. My best guess is this broad basket of commodities ought to look like inflation over the long term. Over short intervals, specific commodities, no problem. But when I'm looking at a broad basket for 45 years, my guess is a priori, I ought to look like inflation. So we look at this and we say, 8.5 or 8.7 versus 4.5. There's a lot of unexpected changes in relative prices. In other words, it just happened that these commodities turned out to rise at a rate higher than inflation. But we wouldn't have guessed it a priori. A priori, you would have guessed the commodities are going to look like inflation. They turned out to be 4.5% higher than inflation over this time period. Well, that unexpected change in relative prices is also in the futures return. Remember what the futures is. We set the futures price today based on our best guess of what the spot price is going to be when the contract matures. There may be a premium or discount in there, but it's our best guess plus a premium, or it's actually our best guess minus a premium. Okay? If you think the premium is the long. It's your best guess of the spot price minus a premium. What we're saying is the spot price turned out to be 4.5% higher than you would have guessed because of relative price changes. What that says is the futures return was 4.5% higher than you would have guessed. So here's what I'm doing. I'm saying, look, I got 11% here. I'm going to break that down into 3 parts. One part is the T-bill rate, 5.5%. Another part is this unexpected change in relative prices, 4.5%. And again, I got that from the 8.7 minus the 4.2. So I got 4.5% unexpected relative price changes. It's just the commodities happen to be more expensive than we expected. 5.5 T-bill, that's 10. The realized was 11. So based on these estimates, we're getting an average premium here of 1%. How does that look statistically? Well, you know the answer. If I told you the premium on the stock market was 1%, what's your T statistic over 45 years? Not very big. And down at the bottom of the page here, this is all working through the logic here. If you don't trust me, you can read the equations. The T statistic on this premium is 0.55. Not a big number. You certainly would not want to infer, based on the last 45 years of data, that going forward, you should expect a positive premium on your commodity futures. Okay? We've done a little bit more work. This is Truman Clark did most of this hard work here. He looked at the Goldman Sachs Commodity Index. Goldman came out with an index in 1990. The return on that index was pretty attractive before 1990. It's not shocking. Would Goldman come out with a product that had a negative return? I'm not saying they back-tested, but I am saying they filtered. It's just like, we incubate our mutual funds. And the ones where we discover we have a really good management team who's got a great strategy, we open them up to the public. You surely have heard that line before. What's the problem with it? I give you 3 or 4 years of really good incubation returns. Out of 30 funds, 5 of them are going to succeed whether I really had a good management team or not. There's a bunch of studies, a huge bunch of academic studies that look at this. The best one I can refer you to is a paper by Elton and Gruber, if you want some fun someday. They go and they get the data out of the prospectuses for the funds that go public. Their returns are incredible before they go public. They're cherry picking. Well, my suspicion is Goldman was basically doing the same thing. Since they went public, the average return was 2.8% a year. This is not a collateralized return. There's no risk-free rate built into this. Okay? And the other interesting thing here is, if you take the first 10 years, it's almost exactly 0. It's only the last few years where this commodity fund has done well. And I remind you, how many of your clients were asking for commodity futures 3 years ago? Not a lot. Well, let me say 4 years ago. What did they want 4 years ago? Growth stocks. Why are they like commodities today? Because commodities have done well recently. I'm not saying that you can't draw any inferences from that number. All I'm doing is reminding you, your clients have a tendency to chase whatever did well. The T statistic here, it actually turns out to be very similar to the number we just looked at. That's totally random. Okay? But it's certainly far from any critical value that would make you say, gee, this is a positive investment. Particularly when you remember the reason we're looking here is because these guys have done well recently. What about thinking of this as an inflation hedge? How well do futures work as an inflation hedge? Let me say it in 2 words. They suck. And it's easy to understand why. The volatility on the futures is about 15 times the volatility of unexpected inflation. In variance terms, it's 200 times the variance of unexpected inflation. And remember, variance is add. So I've got huge volatility on the futures relative to unexpected. I'm going to cheat here. I'm going to use total inflation. The variance of total inflation is actually higher than the variance of unexpected inflation. So the numbers I'm using here don't even tell how bad the picture really is. If I did this right, the result is even more extreme than this. So here's the easy way to think about it. I take this broad basket of futures contracts. I tell you inflation moved up unexpectedly by 1%. What's your guess of what happened to the futures? Inflation moved up by 1%. What's that mean? That means prices jumped by 1%, right? Unexpected inflation of 1%. So what do you guess happened to futures? There's really 2 effects. One is you get a jump in the futures of 1%. But inflation, at least for the short run, is what's called non-stationary. I get a little extra inflation this month. I expect it to stick around for a while. So it's not like stock prices where you get a big high return today and that doesn't tell you anything about the future. Inflation, if inflation jumped to 10%, you would expect it to persist for 10% for a little while. So I get unexpected inflation this month. I expect it to persist for a little while. The commodities that the commodity funds we're talking about here are holding contracts that have maturities of roughly 2 months. So there's 2 effects of unexpected inflation. One is the current jump in the futures price, the current spot price, plus the increased rate at which prices are expected to grow over the next 2 months. So the 1% here, a 1% unexpected inflation should change futures by 1.17%. The 1, that's the current jump in the spot price. The 0.17, that's 1/6 of a year times the 1%. Okay? I get an increase over the next 2 months because of the higher rate of inflation for the next 2 months. So what that says is 1% unexpected inflation should change futures by 1.17%. If I ran a regression of futures on inflation, my guess is, before I start, I ought to see a coefficient of 1.17. Then I can back out, what's that imply about the correlation? How do I do that? Well, just play with the formula. And all I got to do is adjust by the relative variances or relative standard deviations. What I'd like here is the standard deviation of unexpected inflation divided by the standard deviation of futures. I'm taking total inflation, not unexpected inflation. Total inflation is more volatile, which is going to increase this number here above what it should be. Even when I use too large a number, the correlation I get is only 0.08. Okay? So your best guess, because futures are so volatile relative to underlying inflation, is your best guess is a correlation here of only 0.08. And now you're going to try to use that as a hedge. How well would it work? Well, in the interest of time, let me show you the bottom line here. Imagine you have a portfolio. And your portfolio has 2 parts. It has the real return, and it has the inflation part. Okay? And you're getting hurt by inflation, so you'd like to hedge it out using the futures. How would you do that? Well, if you play with the numbers, what you come up with is, for every $100 that you have in your portfolio, you would short the futures by 40 cents. Actually, I wrote it so you would short it, but if you were being hurt by inflation, you'd go long the futures by 40 cents. So every $100 in your portfolio, you go long 40 cents of the futures. Right away, you know that futures position cannot have a big impact on your underlying portfolio. And in fact, it doesn't. If I look at the total variance, the variance of my portfolio is the variance of the real part plus the variance of inflation. The standard deviation of inflation over this time period, and I'm using the 45-year period of Rowan, Hurst, and Gorton. The standard deviation is 78 basis points a year. If I take my optimal hedge, assuming I know the truth, and this is always a slippery slope here. It gets worse if you're uncertain about what the truth is. But assuming you take, this is actually what's true, that God came down and said, yes, this is the best you can do, here's what to do. You reduce your volatility from 0.78 to 0.778. Okay? That's your best shot at reducing the volatility of your portfolio caused by inflation using futures. And the problem is easy to see. Futures are incredibly volatile. You're trying to eliminate a little bit of variation from inflation using an instrument that's doing this. You can only take a little bit of that instrument. Otherwise, if you did a one-for-one hedge, what have you got? Basically, you've got a portfolio that's doing this. Whatever it futures is going to swamp your portfolio. Now, just as an aside, it's not in my notes, but you hear people say this all the time. I will diversify my portfolio by taking this futures position. Yes, just like you diversify your portfolio by making a $5 million bet on the Super Bowl. What are people missing when they do that? What people are missing is the fact that this is just a zero-sum investment. They're not putting any money up. They're just adding on another type of risk. If you look at the analysis and you say, you know, when I took my money, I used to be 100% stocks. Now I'm 50% stocks and 50% collateralized futures. I've lowered my volatility enormously. Yes, but you would have lowered it even more if you'd just taken half of your money and put it in T-bills without the futures kicker. What you really did was you took 100% stock, took half your money out of that, went over here and put it in T-bills, and made a bet on futures. The thing that reduced your variance so much was the first step. Take half your money and put it in T-bills. And then the second step may or may not reduce your variance. I would argue, my best guess is, it increases your variance. But somebody else might draw a different inference. What am I talking about here? The last part of the problem is this question of whether, in fact, these contracts are negatively correlated with equity or bonds. My guess is they're positively correlated. Other people would look at the same data and say, no, they see negative correlation. I look at these futures contracts just like I look at everything else, as just standard monthly rates of return. If you work in monthly data, all the correlations are positive. If you switch to quarterly data, there's some non-synchronous correlations going on that push the correlations negative. There's no truth here. Okay? It's the same. Some of you heard Rex talk about the fact there's no benefits to international diversification. Or at least, I guess Rex always frames it as, you should invest in small international stocks. It's a statistical problem. It really depends on whether, in Rex's case, whether you use monthly or annual data. Here, you get different answers whether you use monthly or quarterly data. If you use monthly data, you look at it and go, you know what? When equity goes up, the futures on average also go up. And some of you are saying, you know, let's think about oil. we get a shock to oil prices. The futures goes up, the stock market goes down. That's the negative correlation. But that's not the only way you get the correlation. What happens to oil prices when the economy booms? Now the demand for oil as an input goes up, and prices go up. So the market goes up, oil prices go up. So this is a case where theory isn't going to tell us which of these two effects dominates. And the empirical data won't tell us either. So I step back when I think about, okay, what should I be doing? The reason we got into this is because we were getting pressured by a lot of clients that we ought to open a commodity fund. We would have loved to come out with it. The reason we didn't, we don't see any great reason why you ought to be putting your clients here. Initially, we thought, maybe it'll be a good inflation hedge. And there are people who are particularly sensitive to inflation. They ought to be willing to pay up to buy the inflation insurance from other people who are willing to sell it. That's the way we think markets ought to work. But then we realized, it's not a very good inflation hedge. In fact, if that's what you're trying to get, we're working now on thinking seriously about a TIPS product. Okay, so this whole process may end up getting us to do an interesting portfolio, but it won't be a commodity fund. So let me summarize. Commodity funds are probably not as attractive as they first appear. The past realized return probably overstates the expected return. And then because they're so volatile, they're not going to make a very good inflation hedge.